Good morning, everyone, and happy Friday. It is August the 1st. I cannot even believe we're like 4 months away from 2026. I feel like it was just yesterday that we were celebrating 2025. But today we have a very special guest, and it's focused on business, finances. A hard lesson that I learned on my own last year when I went on my business because I was became an entrepreneur, and as a sales background, I had no idea what it meant to keep record of your bookkeeping, your taxes. Like I always say, you could have all this revenue come in and be net negative
Yep.
as things that you don't know. And that's why I'm very happy to have Mr. Mason Brady, who is the CEO of Brady CFO. So I'm going to let you introduce yourselves to our guest, Mason, and let us know what you do the best.
Yeah. So Mason Brady here with Brady CFO. And yeah, we're just really interested in, we want to help construction business owners build their dream business and actually have the financial plan and strategy to get there. I mean, that's our goal. And whatever that might look like, I think that there's a lot of ideas pushed on business owners as to this is what your business should look like. This is what you want to do. And sometimes we talk to business owners and they just say, hey, I want to be able to show up and I want to be able to do estimating. That's my favorite thing to do. And I don't want to have to worry about whether my business is sustainable. And so we create financial plans that allow them to actually do that. And that might mean hiring some other team members to make that function, but they need to know that their finances are working properly, that can fund that, and that allows them to actually thrive in what they want to do in their business, whatever that might be, however much they might want to grow it or what they want to do outside their business. We've had clients recently go take 3-week vacations to Italy, and we say, great that you can do that. Glad that we have everything in place that you are set to go do that. So that's really what we're interested in, is really just serving business owners, making sure that their business isn't driving them, that instead their business is a tool that allows them to, tap in and get what they want out of it in life. And whatever that might be, everybody has a different vision of what that might look like, but they need a financial plan to get there. And so we come in and we help with that.
Excellent. And then what's one common mistake that you have seen that employers do, across the industries? Because I know you have you have niches that you like to focus on.
Yeah, I mean, for us at Brady CFO, we work with construction businesses as well as food and ag businesses. It happens to be where we have a lot of expertise. The biggest mistake that I see business owners make is if they happen to pay attention to their financial reports, which that's a mistake in itself, is oftentimes people don't really look at their finances very often. They don't really understand what's going on, whether they're making quality margins, et cetera, et cetera. The bigger mistake that I see is nobody pays attention to their balance sheet. Nobody understands it. I think generally business owners can get an understanding of their P&L, or AKA their income statement, because even if they weren't a business owner, in life, say if you had W-2 wages, say you were working a salary job, you understand you have revenue from that job and you have personal expenses. People generally understand an income statement or a profit and loss statement. Where they get tied up and they don't understand and they don't spend enough time on is the balance sheet. And I say that we worked with a general contractor we were doing a due diligence as part of onboarding with them as a client, and we just asked. I pointed at a line on the balance sheet. It was an asset on the balance sheet that I said, "What's this? It's worth $1 million," and they were making $1 million in their business that year. Ended up being that asset truly didn't exist. And it hadn't existed for a very long time. And we needed to write that asset off. And now they were at a break-even point in their business. They were not making $1 million anymore. And so the fact that just nobody paid attention to the balance sheet, there's nobody reviewed it. So that's really what I want business owners to take away, is spend some time on your balance sheet. You need to understand it. It's the map that says what your business, where your business sits in terms of its asset value, its equity value, where all your debt is, what's happening with your debt. You need to understand it.
Yeah. And then for us, people like myself who I don't know, balance sheets, or if I look at one, what to look for, how it's calculated. I guess what advice or how could you guide someone with very to no little experience of what to look out for on their balance sheet?
Yeah. The first starting point is just, as a business owner, you don't be afraid of looking at your financial reports. And I would say that if you're working with somebody, whether it's your CPA or you have an internal accountant, bookkeeper, you should be able to poke at a line on your balance sheet at a value and say, what's this? And you should feel comfortable doing that. And if you don't feel comfortable, that is an issue in itself. Either that's something internally for you that you need to work through, that you don't have to be an expert in finances to at least be inquisitive about what's going on in your own world. The other aspect is if the other party that you're asking the question of isn't really a servant teacher at heart, and either that or isn't able to explain what that item is and why that value exists, if they are not easily and simply able to explain that, you have another problem on your hands. And don't take it, that, oh, well, it's accounting. It just is what it is. My CPA or my accountant says this is just what it is. I need to accept it. That's probably not true. You need to understand it. And if you can't get your own understanding around it, that's a problem itself. So be inquisitive, be willing to look at each line of your balance sheet and make sure that you have an understanding of every line of your balance sheet, just that you're comfortable with it, that you have a general basis understanding what makes it up and why, how does it work, and feel comfortable to ask questions of the party that's actually preparing those financials for you. Beyond that, kind of going more technically in depth, the balance sheet's made up, and basically what you're looking at is your assets and your liabilities and your equity. So the assets being, what's all your working capital that actually, from an operating standpoint, helps you run your business, your cash, your accounts receivable, which are your outstanding invoices to your clients, your inventory. And then you have fixed assets on your asset section. So any of your equipment, your trucks, your land, potentially you own your office, et cetera, et cetera. And there can be some other things on there, but they're assets. They're things that you own, that you have possession of, that you have some type of title to. Then you have your liabilities, which is all the debt that you have due, whether it be to vendors, whether it be to, say, if you're a general contractor, into subcontractors, any of those payments that need to be made. The liabilities is made up of everything that you owe to other parties, and equity is basically what's left over. And assets equals liabilities plus equity. And so the idea is that the assets should actually be the biggest part of your balance sheet, should carry the most value. But your assets are financed by either liabilities or equity. Equity being, what you invested in the business, as well as over time, if your business makes money, what are the retained earnings in the business? What have you accumulated in terms of equity in the business? And so really, that's what you want to understand at a general sense. But I would again say and go back that just be inquisitive about your balance sheet. You should be able to understand every line as a business owner. And if you feel like you're not getting a good answer to it, you should be begging the question, do I have the right party preparing my financials?
Yeah. And I'm glad you bring that point up, because I think all of us have experience where we go to a tax person, an accountant, a CPA, and they just say, well, it is what it is, and that's what we have to pay. People like myself, who I don't know anything, you just end up paying the bill. You're like, all right, well, I don't know. And then someone else looks at it, and they're like, why are you paying so much? Well, that's what you want me to do. And then you're kind of like, oh, learn the hard way.
Yeah, do not take that at face value. I mean, granted, especially within the tax code, there are going to be nuances of the tax code that are going to be very difficult to understand, because the tax code is incredibly nuanced. I mean, there are elements of even, the most recent tax bill that was introduced, where to take advantage of its incentives, I mean, the amount of doors that you have to go through to finally get the benefit is pretty immense. So I would say even, from a tax return perspective, there could be some things that it's even as a CFO, sometimes we don't even recommend. So within our services, we work internally with clients as their total financial manager. Think of us as your quarterback. We're coordinating with CPAs to get audits done, to do tax reviews. We're kind of this generalist that can help manage clients' finances on a total sum. But the thing is you want a tax advisor or CPA that really is a tax expert. And you have to think, the tax code is thousands and thousands of pages long. To understand it, and it changes regularly too. So to understand it, you need people that are in-depth experts on it. And I'm not expecting even business owners, even as CFOs, we don't know everything about the tax code. And it changes per state too, right? That especially if you pay income taxes per state, California has an income state tax code. Texas, for example, where I live, doesn't. So there's all different types of nuances there that you have to understand by state too. Even as CFOs, we're not experts in the tax code, but I would say that your internal financial reports, you need to have understanding of your internal financial reports. If you're using QuickBooks as an example to do your accounting, you should be able to spit out a report and generally understand what's going on in your internal financial reports. If you don't, something's amiss. And if somebody can't explain something to you, that's a miss too.
Okay. And is
Yep.
that a service that you help out, that you offer? If someone were to reach out and say, hey, can you look at this and
Yep.
let me know if I'm using my tax benefits correctly?
Yep. Yeah. I will say that we don't personally do the tax filing, but we certainly will poke. And what we like to do in our engagements with our clients is have the client have an outside CPA that actually does the tax filing. And we're going to try to, work with that CPA to ultimately come up with, hey, what are the potential tax strategies that we can take advantage of? Where, and I think the next question that becomes is for business owners, well, why do I need you to do that? Shouldn't my CPA be doing that? And my answer to that is, yeah, your CPA is going to be incentivized to try to help you reduce your tax liability as much as possible. That generally is good for them, that it shows that they did a good job for you. The problem that exists with that is that if you reduce your taxable income as much as possible, banks hate that because it shows that you're not making any money and you don't have the ability to service the debt that you might be looking to get with them. So if you were looking to go get equipment financing, they're going to be begging the question, can you make the debt payments? And if you don't show enough income to make those debt payments, well, you're out of luck. You're not going to get the financing you need. And so there's a balance to be had in regards to, it's not just all about tax strategy and trying to lower your taxes as much as possible. We come in and we try to help create a multi-year plan for the clients that, hey, this year we can adjust and do different scenarios of this could be our tax liability and this is what we would owe the IRS or, the state. And we'll still be able to meet the loan covenants to make sure that we get the bank financing that we need, that you can maintain your credit line, for example, and that you'll need potentially for bonding or whatever the case is. We're going to make sure that you keep that in place. You still meet all your loan covenants. And then even we can look forward to next year and say, this is what your potential tax liability looks like given these assumptions next year. And we're working with the CPA to get, some insight into what are the strategies, hey, this is what we'd like to do. What can they do specifically within their entity? Because the tax code's written in such a way too, that there's nuances per entity type, right? Whether you file as an LLC, you can be an LLC and file as a C Corp or an S Corp. Like there's all kinds of nuances in there. And so we're really working with the CPAs as the tax expert to get insight into, can we take advantage of these tax benefits? But at the same time, we're trying to make sure that we're balancing the need to try to reduce tax liabilities, but yet make sure that we maintain financing and the ability to procure financing for that business to continue to grow. Does that make sense?
Yeah.
Yep.
No, it makes total sense. And it leads on to my next point, which is why I think what your company does is fantastic, because what often happens is that a company will grow from one person and then 6 months later if it goes great, it might be 10 people. Next thing you know, you went from a one man show to 50 people, and now you're wearing all these multiple hats. On top of that, you're managing your insurance, which is already a whole different world.
Yep.
And you come to yourself asking, like, okay, I need to have someone that comes in as an expert to guide me and show me where is it that I want to go, because everybody wants to grow.
Yep.
I've never had anyone where I asked the answer, do you want to grow your business? I've never said no. I actually want to reduce it. At times, maybe if they're their credit is way overboard and they have too much liability, sure, they want to go back. But no one ever says I don't want to grow anymore, because you're in business, right, to make profit. You're not here to just have your brand out there. Especially as an entrepreneur, you take so much risk on your own. You're putting your business, your line, your bank your family's food on the table. Because
Yep.
every day as an entrepreneur, you have to go out there and get the money.
Yep.
Now the question comes in, how do you keep that money and grow that money?
Yep. Yeah, very much so. That's where with any one of our clients, foundationally, they need a cash flow forecast, right? That, and not just a cash flow forecast, but a holistic model of, okay, if we make this amount of money, if we, make this little tweak and we improve our gross margins, that, if we try to make sure that we balance our overhead costs and we can, improve our net profit margins, and how much debt do we have to try to pay down? What money do we want to pull out of the business for various objectives? Like I said, we have clients that we have a food and ag client as an example, located in Central Valley, California, that his objective is he wants to be able to walk his stone fruit fields every day, go drive through the fields and be able to irrigate them and be able to do those things and just make sure that his business continues to fund that lifestyle, that he can just farm. And so he has a primary business that's the goal is to fund his farming that he can live off of into retirement. He's getting close to age 60 and he says, this is my plan, is that this is what I want to do. I want to begin to do less and I want to be able to walk these fields every day, but I want to make sure my business is funding this ultimately. And so we build, a holistic plan and a model, but it really does start with having a clear forecast that, hey, where do we want this business to go? And we have to start with the questions as to what do you want out of this business? What are your growth goals? And those are different for everybody. I would say that every business does need to grow. The rate of growth is different for everybody, right? Because, even as an entrepreneur, the internal transformation that it takes to go from, if you're the owner of a $10 million business and you want to become a $100 million business, you better believe that internally as a person, the owner of a $100 million business is going to be a different person than the owner of a $10 million business. Like internally, how they think, how they lead, how they carry themselves, what their day is focused on, it is going to be a different person. You are going to talk to a different individual that thinks with a different lens. It is. And because it demands more of the owner themselves. And so it's really important to beg yourself and ask the question, what do I want to do? And then you can develop a financial plan around that. And it starts with the forecast that, hey, what do we want to be able to do with this business? How much money do we want to make out of it? How much do we want to pull out of it? But ultimately, we need to understand, where do you want to go? What are your hopes and dreams? What would you like now out of the business? What would you like to see yourself doing? And we need to develop a plan around it that includes forecasting and making sure that, what do we do with the cash that this business, creates? But then once, it creates it, that what are the opportunities? And those opportunities can be varying, right? That it doesn't necessarily mean that it even needs to stay inside the business. And oftentimes that's what we're helping our clients with, is they have great cash flowing businesses. They churn a lot of cash. But then the question becomes, well, I'm making so much money, I'm going to have this big tax bill. How can I avoid the tax bill? And at the same time, I can take this money and get a better ROI out of it, because I'm not, I could keep it in my business and continue to try to grow it. There's also additional opportunities that exist too. And they might be integrated opportunities with the business. I brought up that example of that Central Valley, client that, he has a packing house that he packs fruit and ships it to major retailers. Well, him owning farmland is a really good integrated part of his supply chain, right? And so him taking money that he earns from his packing operations and reinvesting it into farmland, so that then he's got additional volume to run through his packing operations. It's growing the whole thing together, but he had to pull money out of his packing operation and go invest it into additional farmland investments. But those are the things that we're helping clients evaluate is that farmland investment, is that a good investment? Is it going to produce a quality ROI, both as an individual investment and in the business, right? And so it really, we want to understand where the business, what the business owner wants to do, where they want to go with their business, what are their hopes, dreams, and goals, what they want out of it immediately. And we got to develop a financial plan and forecast around that. And, but investments and what they do with the cash, it can be varying, that it can include a lot of different ideas. That we want that business owner to think big. It doesn't necessarily even need to stay inside the business. There's a lot of things that you can do with your spare cash, but we're not going to say no to any business owner that, what their hopes and dreams are. We just want to understand them and make sure that we plan for them.
Yeah. And then touching on construction and contractors, I know, once they start making over the $1 million revenue and so forth in the cash, they look into buying properties, either being residential or commercial. Usually they want to join or create a group where they're able to buy commercial properties.
Yep.
Yeah, but this is like, it's a new stream because they're used to their craftsmanship, their skill. So they really don't know what it takes or how to know if a deal is good or bad. Is
Yep.
that something you could help them strategize or plan for?
Absolutely. We have several construction clients that do development projects outside of their primary construction business. And that's actually what they want to grow more. They want to become a developer that, they have a skill set as a contractor and they want to become a developer. And I would just say that to anybody wanting to enter that world, we just looked at a prospect recently that once we dove in and understood their financials before we started working with them, they just acquired a piece of land. And be careful, right? Be careful about that, about how much cash you put down. It might enable you to get a slightly better interest rate. And this is the things that we're able to evaluate with the clients that some clients will make decisions. Well, hey, isn't it just good that I get a lower interest rate or that, I carry less debt? Maybe, because the problem is you can take a lot of cash and then pile it into that real estate. Well, what if your primary business ends up having an issue that needed all that cash? Now, there are banks and lenders that will lend to you on the basis of that real estate that you own and provide some financing from it if you happen to need that cash again. That just becomes hard, right? And so, the big thing that we want any contractor to consider, that if they're wanting to go into some type of development and to buy land, is just be very cautious. Make sure that you have your ducks in a row. You probably need a credit line in your business first, so that you have something that, from a pivot standpoint, that if you start running into cash flow issues, that you have outside capital that can allow you to pivot and be able to, handle a couple bad months, and that you can, figure out what to do. But yeah, you also want to be careful about over leveraging yourself on that real estate as well, because you can put a cash down payment down, but during development, you're not going to have any income coming from it. And so if something happens to your business in that interim, you could be, in a very difficult position. And so we'd really want to see, a client that maybe is getting in, for their first time, be very careful. If they're getting in for their first time in development, it's very important to choose a business partner, but if you can bring in an equity partner that maybe you do the work as the developer, but you bring an equity partner that brings in the cash, it's going to be a better thing for you than over leveraging yourself. But there's so many considerations to take into account. What I'm getting at is we want the construction business owner, the contractor, et cetera, we want them to be very careful that just because their business is doing good now, things happen in the economy that, can turn down demand. And we want them to make sure that they have enough liquidity in their business to be able to weather a storm. And so just be very careful about pulling too much money out, placing a piece of land that you can't then tap for capital later. That's what I'm getting at.
Yeah, and I think you hit a very important point, especially with today's economy where many people are over leveraged. I believe that there's a report that this time there's so much credit debt that there hasn't
Yep.
been this much credit debt in I don't know how many years, but it's
Yep.
at that point.
Yep. Yeah, it's huge that I sat in a talk, I believe 2 years ago, that I had no conceptual understanding of this, but they said that the entire credit market in the United States too, only like 10 to 15% of it is made up by traditional banks. And where I'm going with this and what that means is there's actually a lot of private debt lenders out there. And there's actually a lot of private equity companies that aren't necessarily wanting to make equity plays, but will make credit plays. And so they'll offer credit investments. And it has absolutely exploded the credit market in the United States, that there's just a lot of, companies that have taken on credit. And there's a lot of credit out there. But yeah, it has exploded. And it's just, it's important, if your debt if your amount of debt is too high, I'm not against debt. Using debt actually does allow you to produce a better rate of return on your equity invested. And what I mean by that is that if you go buy, $1 million piece of property and you're able to put 25% down, leveraging debt at, a decent interest rate. And if you had to put no additional capital in that business and you pay that debt off over time, your rate of return as a result of using that outside capital is going to be greater than if you had to pay $1 million for that piece of property yourself. Your rate of return will be better by leveraging debt. I'm just saying, don't over leverage yourself. Be careful, because we walk into too many client situations where they just have too much going on, that they're spread way too thin. And all it takes is one domino to go wrong and the whole thing is going to fall apart. And we're not, once you burn business relationships too, that can be really difficult to try to recover from. And so your endeavors as a new entrepreneur, it may be really hard for you to recover from that. And so, yeah, I'm not against debt. Debt is a strategic tool to be used. Just want to be very careful about over leveraging.
Yeah, no, and you bring up a very important point, because I feel like the mood has shifted from what it was maybe 2, 3 years ago. And I'm seeing from my clients, what they have shared with me. They were more aggressive towards what they were purchasing. This year, not so. I've actually seen a lot of them regress back. They're like, we're taking a conservative stance on everything, because of how the economy's placed. And as you know, there in some industries there's been a shortage, in construction. And actually, I just had one really well known, one client of mine. They were going to be the general contractor in this very large, um, build, and they decided to not go through it because financially they looked at it. It's like, dude, this is a huge risk.
Yeah.
We might end up losing, so it's way better off we just put this deal down, don't move forward, and look at it from a financial standpoint.
Yeah. I mean, it's difficult because, especially with the tariff situation going on
Yes.
and the variability in the tariff situation, because I think some of these tariffs plays are just, they're just threats right now, right? And they're not meant to last forever. Even some of the tariffs, I don't know how long they're going to last. Is that in perpetuity? Is that for multiple years? Or are we talking by the end of the year that some of this may go away? Nobody really knows. It's just recently the news came out. I don't even know if, it could change while we're talking, but there's a 50% or 51% tariff introduced on Brazilian goods, right? It's wild. And so it's very difficult to plan. But especially within your contracts themselves with the building owners, whoever you're doing projects for, if there's not appropriate language in there that allows you to pass along some of the costs of some of these tariffs, as your input prices increase, as your supplies and materials increase, you're taking a huge financial risk. And yeah, you could pre-purchase materials, but the problem with that is, you're going to end up with a lot of waste and shrink. That there are companies out there, let's put it this way, grocery stores and distribution centers, they don't tend to be big margin businesses, and they are in the business of purchasing and holding goods. That's what they do all day, and they are not huge margin businesses. You think even like a grocery store that has such a stock of inventory, grocery stores in the United States make maybe 2 to 3% net profit margins. It's incredibly weak, and they're not great. They're not great profitable businesses. So what makes you think that, as a construction business owner, you're going to do a whole lot better by pre-purchasing and inventorying a bunch too, right? It's probably not going to work out, because there's companies that do this all day long that they're lucky if they make a profit. And so, you do take on a lot of risk, because there could be shrink and overhead. What if something happens to that job, that you bought all the supplies and materials for, and something happens, and then you have to figure out a way to liquidate your supplies and inventory? Yeah, you could pre-purchase. Not really a great plan. Our advice to most of our contracting clients is, only pre-purchase what that you will need on jobs over the next couple months. That you absolutely know that you're going to need these supplies and materials, but don't do anything speculative. But going back just in general regarding these tariffs, If you're not able to pass along cost in your contracts, you're stuck. And maybe you shouldn't take on that job because there is so much risk that although it could be a big banner job that it'd be great to promote your company, maybe it's not such a good idea if you're going to take on that much risk and the margins aren't that great. And I do agree with you that we have seen, I think everybody, it's not that companies are doing all that bad. It's just I think everybody is a little bit hesitant to make decisions because they don't know, is there something about to just disrupt their world in a month from now? And so they're a little bit more hesitant, a little bit more cautious. And we're seeing that amongst many of our contractor clients, not just them themselves, but even their clients. They're the owners, that some of their jobs are not taking off quite as fast as expected. Some of their estimating and some of their projects that they had in the pipeline, this question mark, is that actually going to be there? Is that going to take off like expected? I think we are in an environment where everybody is just walking with a little bit of hesitancy right now. I do think that there is good hope, that when you combine a lot of what's happening in regards to tariffs, if we can get interest rates down through the federal government, what is in the tax bill, there are some great incentives in the tax bill for building, for contractors to be looking at, especially from a business development standpoint. But I just think it's going to take some time. Can you
list one of the common ones for the people out there listening?
Yeah,
I might not know about this.
So one big thing, this is a pretty common or popular one, but bonus depreciation is back, or 100% bonus depreciation is back, and that meaning that if you have to go buy a vehicle, a large piece of equipment, whatever the case is inside your business, that you can basically write off the full value of that piece of equipment in the year that it's placed in service. That is not us saying go buy equipment for the sake of buying equipment. Buy equipment if you need it, if you really need it, or don't go buy a brand new Ford F-350 right now just because you got bonus depreciation. If you only got 50,000 miles on the truck you got, probably keep riding it, right? But you keep driving a little bit longer. But if you were on the tipping point as to whether this is affordable or not, it just became more affordable because basically you're going to have a lower tax liability as a result of being able to purchase that equipment. And so 100% bonus depreciation on equipment is a big deal. What we've been exploring more, and what I think a lot of contractors should be focused on, there's something new in this, in this tax bill, and it's 100% bonus depreciation, not just on equipment, but on what's called QPP, qualified production property. It's a big term for generalized manufacturing facilities, industrial. Think industrial. Basically, it's a location where you put two things together, you make something. That's what's happening in a qualified production property. So it can include packing houses, manufacturing sites, etc. 100% bonus depreciation on QPP, meaning if a developer comes in, buys a facility for $100 million, that $100 million valued facility, that $100 million is a tax write-off in year one. And so the idea that you're not going to produce anywhere near that amount of income, so you just completely eliminated an income tax bill for that site. And you have the ability to carry forward those losses. And again, we're talking about $100 million tax write-off that if you happen to make $10 million of income year one, $20 million of income year two, and you stabilize that, that means it's going to take you between 5 to 6 years to eventually have a tax bill on actually building or buying that manufacturing facility. Now, are contractors going to go buy that themselves? No, but be rubbing shoulders with developers that will, that there are developers that are going to take advantage of this tax benefit. This is an unparalleled tax benefit that has never been seen in a tax bill before. Previously, a manufacturing site or industrial site like this had to be depreciated over the course of 30 years. You can depreciate the entire thing in year one and completely write off tax bills. And so you better believe that there's going to be a lot of investment going into building new manufacturing facilities or QPP, qualified production property, as well as, remodeling existing ones, et cetera, as well as buying existing ones and then remodeling. There's going to be a lot of activity. So for contractors, look to see how you can get more business in the industrial space. That is going to generally be a space that is booming over the next few years, at least in my opinion.
Okay, well, do you just like put up a light bulb? I'm like, oh, that makes sense why they're purchasing. Well, I'm glad you say that because I do have prospects and a couple of clients who are in that 100, close to that 100 million gross revenue, and definitely developers as followers who do that and focus on that. So thank you for making that point.
Yeah, I mean, there's multiple different things, but I think it's important for people to realize, regardless of what political, aisle you stand on, generally Trump's platform was he wants to bring back U.S. manufacturing, and so he put in there no taxes or no income taxes on overtime, because we do have a labor supply issue in this country. I mean, coupled with poor immigration policies overall, and we have a labor supply issue. Well, we're going to have to incentivize people to get back into manufacturing. I have a question mark whether no income tax on overtime is actually going to really move the envelope or not. But reality is that there's incentives for people to go develop a manufacturing site, and there's incentives for people to go find employment at manufacturing sites. And if you look at what Trump's original platform was to get voted in, it was bring back jobs and bring back manufacturing in the United States. Regardless of what your opinion is about whether that's correct or not, that's what that's what his platform is, and that's what the tax bill is all about. And he put a lot of incentives around in doing that, and that's a part of the tariffs. I mean, everything he's doing is combination around all of this of trying to make it so that a company that, say in Europe or in South America, a company in Mexico or wherever it might be, if they have a manufacturing site in that location and they're shipping in the United States and they're selling, a high volume of products and services in the United States, what he's trying to do is to say, stop the manufacturing in that site, come into the United States, build the manufacturing site here, and employ the people here, and then sell it to the U.S. consumer. And regardless of whether you think that's correct politically or not, that's what he's trying to do. To that point, contractors should align themselves in the industrial space and start rubbing shoulders with developers in the industrial space. That is our opinion when we read this tax bill.
Yeah, of course. And then, politics and all that change every 4 years. So it's what I always say, whatever the laws here in California, things are always changing constantly.
Yes.
So I always just say, this is what it is. It might change, may not, but this is what we have to work with. These are the fields.
Yep.
Compliance.
Yep.
So it's just, I always say business, politics, two different separate things, and the business environment is what you're dealt with.
Yep. So. Yep. Very much so. And this is the thing, like kind of taken away from that, right? That this is the value that we want to bring to our clients, that business owners, we want you to be aware of these things, but do you need to understand the technical nature of them? No, right? That's not what you need to be spending your time in. You need to be spending your time as a business owner. I would say through certain stages of growth, some of your biggest focus is getting that next job. As a business owner, your primary focus, and when you're first starting your business, is getting that next job, putting that, next line of revenue on the board, get that next job. And then it eventually evolves to where once you're at a revenue base to where you can actually build out a team and finance a team, then you need to start wearing that CEO hat and become the leader that your organization really needs, and to actually have people, employed that actually go get that next job, and you're leading a bigger company at that point. And businesses go through these stages of what is demanded of the owner themselves, but we want the owners to be aware of these things that are available and to benefit them. But like you said, it changes. Federal tax laws change, state tax laws change. If you happen to be a contractor working in, multi-state, oh man, I'm sorry, your hair is going to get a little bit grayer. But we just don't want you to deal with the complexities of it. That's our goal, is that, some of these little compliance pieces around tax code, finances, and we're not necessarily going to do the tax filing for you. Like, we're not going to prepare your tax returns, but we're looking at what's in the tax code and saying, okay, as a business, this is where we should try to align you. Like, this is what we want, you to be able to take advantage of. And I think this, to me, I guess if I could be on a platform and say, this is the value of a fractional CFO for growing businesses, like, this is it, is that we want to help make sure that you're seeing these opportunities, and that you're not blind to these things that we're helping you take advantage of them, right?
Yeah. And I think it's very good because it's an outside perspective. You're coming in as a third person and really guiding the company, not knowing anyone. Because sometimes when you hire someone who's within the company, there might be certain feelings or emotions that
Yep.
maybe don't want to cut anyone off or do certain things because it might upset people. You're just coming in here, just logic or scratching out, redlining, and going to show you how to grow your business.
Yeah. I mean, if I could be direct about it,
Yeah.
we see it oftentimes that somebody inside the business, they're afraid to speak up to the owner
Hmm.
because they feel like their job is on the line. Their primary
Yeah.
source of income is on the line. I'm going to tell you right here, like any one of our team members as fractional CFOs, we're serving business owners part-time. And so we have multiple clients. An impact of if a client didn't like the advice that we told them and they walked away, like, is it absolutely destroying our personal income? Absolutely not. I mean, that's the way it's designed. And so we're kind of in a position to where I tell any one of our team members, our greatest act of service is telling the truth with respect and love. And we need to be in a position to do that, to say, hey, this isn't a good idea. What you're doing is not a good idea, and we need to do it another way. And at the same point, bringing examples from our experience and perspectives as to why it needs to be done that way. The owner may decide not to do it that way. It's okay. It's still their business. We're not going to shove something down their throat. But yeah, we're in a position, like you said, as an outside perspective that, we don't have, skin in the game like an employee that it's their sole source of income. We're going to tell you and look hard in your face and say, not a good call. Like, we need not to do this. And we've done that before where, I mean, we've worked with some clients where we said, you keep pulling money out of this business to go do these residential real estate deals, with your spouse. You keep doing these things, but it's actually the bank of your primary business is really concerned about continually financing your primary business because they see you pulling all this cash out and you're not really bringing it back. And this business is going through liquidity issues now. And so the bank is actually concerned as to whether they're going to be able to continue to bank you. And we just had to tell the owner, point blank, you can't do any additional real estate development projects for a while. We'll let you know when. And, some may say that, oh, well, that sounds harsh, but it's like, that was the best truth that we could have told them. It's not that we don't want you to do those projects. We need 12 months of a pause here where you don't do those things so that we can clean things up a little bit. You finish out the current projects and then go for the next one. But you're about to jeopardize something in your primary business that would be really bad for you. And we're going to tell them straight to their face. It's just, I believe the most serving, act of love that we can do is to be truthful, but obviously with respect and love, that we want to help you achieve your goals, but maybe what you're doing is actually contra to that. Right. And we just want to be honest. So.
Yeah. You have the same perspective as I do when I come in as an insurance and risk management standpoint, right? Like, I'm not here to do the HR's job, nor do I want to do the HR's job. I'm here to guide them, hold their hand, and help them out in understanding, like, hey guys, we got too many claims here. Like,
Yep.
we are like, everything needs to be crystal clean moving forward, because the next one, if you're paying 200K right now, you're
Yep.
going to pay 300K for sure next year if you blow through another
Yep.
$50,000 claim.
Yep. I mean, for the HR manager, it's like, you're probably overworked. Wouldn't you
Yeah.
want an HR coordinator? Well, sitting right there, if you didn't have those claims, right? Like, you'd get that new employee if you didn't have this claim history. And so if we figure out how to do this, you get what you want out of this too, that you can make the case that you finally get the help that you need because the company can afford it, right? So yeah.
Yeah.
100%.
100%.
Yeah. So I just business owners, they have, complex things going on. There's just so much to manage. And oftentimes as they grow, it's very rare that we see that the business owner is all in on one thing. That's not how business owners in our experience are generally wired, that they're visionary, meaning they have a new idea every week, right? And they're passionate. That's what made them start the business, is they're passionate. This isn't always the case, but it's a high majority of the case that business owners are visionaries. And that means that they're going to grow their business, but then they're going to be looking for the next thing too that they want to do. And they're going to have these layers to it. And it's just so important to have appropriate governance over everything that's happening, both from a financial standpoint, a risk, an HR employee and liability risk management standpoint. But once you start entering those other ventures and you start having multiple different investments outside of your business, even inside your business, but outside of your business, it really grows the complexity to where you got to have help. That's the big thing is if I could stand on a platform and tell business owners one thing is the moment that you've grown your business up to a certain point to where it's successful and it's a good cash flowing entity, you might need help to get it to that point, but especially once you've reached that pinnacle, and you want to consider some outside investments and you're going to add some complexity to your life, be prepared that you're going to have to bring in good advisors that help you do that well. Like you're not going to be able to do that perfectly alone. You're going to probably screw something up. You're going to pay a tax bill higher than you should pay. You're going to have an employee liability concern that you didn't even think or consider about. You are going to need some advisory once you get up to that point. And it's just because the complexities of it become so difficult to manage. And so just as business owners grow, they need to be aware that you got to bring in the advice, right? You got to bring in good advice.
Yeah. And for right now, what would you summarize? What advice would you give someone who wants to grow, but maybe is like strapped on with cash? They're just like, oh man, like I have, I'm barely making it.
Yeah. I would say, so there's multiple different reasons that can cause a cash flow concern. One could actually be a really cool reason. You're growing too fast. Because what people don't understand, or what I find a lot of business owners don't understand, is that rapid growth does not necessarily mean that you're a good cash flowing entity. Actually, rapid growth screams cash flow issues, because you think about it, you perform the work, you got to pay all the employees for all the materials and supplies, unless you were able to bill those, immediately to, the owners, your clients, et cetera. But especially if you're direct, if you're performing the work directly yourself as a contractor, maybe you're a subcontractor or you're a general contractor that performs direct work. If you're performing any of the work yourself, you have employees to pay, you have payroll to pay. And so you got a lot of expenses going out the door. And if you are waiting on those invoices for 30, 60, 90 days, and you're doing a lot of work, you can imagine you got a whole lot of cash going out the door, and you got that cash sitting in your accounts receivable that you're waiting to finally collect. That causes a cash flow issue. There's great ways. There are banks that will absolutely look at that AR and say, yes, we can finance that AR. And so I would tell them, you need to start establishing some quality financing relationships to actually help you tap into that asset of what your accounts receivable is. That is a wonderful problem to have, that you're growing so fast. At the same point in time, be careful, again, how you manage your expenses during that period, because sometimes people see rapid growth, or business owners see rapid growth, and they think everything is going great. I can spend money on this. I would say that actually the time at which you probably need to be the most lean is during that rapid growth, because if you get overdone on expenses, you're growing so rapidly, you don't even have visibility into your finances that well. You're not able to predict what's about to come or what's about to hit that well. And so just operate lean, but you should be able to get financing to tap into that asset of your accounts receivable due to your growth, dependent upon everything else that you got going on in your life too, because banks will make decisions based upon many factors, not just how your business is doing. If your cash flow concern is a result of you just have terrible margins, we got to figure out why you have terrible margins. And it could be there is something in your contract, that is preventing you from passing along increased material supplies, costing, et cetera. We got to figure that out. Maybe you're not utilizing labor correctly. Maybe you have a lot of employees that are just standing around and not actually performing the work that you want them to perform. And maybe they're not incentivized appropriately to, basically keep the job on budget or to beat budget. We have to wrap ourselves and figure those things out too. But I would say that is a very difficult problem to solve, because there also might be emotional concerns of the owner themselves that I find too often. We step into client situations where maybe the company is performing, they do have some cash flow concerns, and it is a margin issue. It's not necessarily a growth issue. we come in and we try to help them, or at least we talk to them about potentially helping them. And we tell them, yeah, it's very clear you do have a liquidity issue. You do have, margin issues. And they'll sometimes just chop it up to, well, it's an economy issue. The economy's slow. And it's like, I can guarantee you there's other people doing what you do that are getting the work. Projects are still going. You need to be able to compete against them. But there might be something emotionally and internal about the business owner themselves and the confidence of the work that they're doing to actually, there might be something that we might need to figure out on an emotional level, that you need to bill the appropriate rates. I can't tell you how many times we come across people that it's like, you need to be billing higher. You know that, right? Just you offer more value than you think. You need to be billing higher. And yes, there may be clients that will always take, the lowest bid. Is that necessarily the client that you want? No, it's not. That you want the client that will value the extras that you bring, that you're going to deliver on time. You're going to be highly communicative throughout the process with that client. There's additional value that if you internally as a contractor are just a good operator, you shouldn't be charging the same as the low bid guy. And it's very easy to get caught in this trap that, oh, well, I have to be around that range just to win the work. And no, I would say that you need to be highly confident and to develop your sales tactics a little bit stronger and to develop your marketing plan a little bit stronger. But I guess where I'm going with it is in the cash flow concern side, especially if it's a margin related issue, it could be a variety of issues. I've just listed several of them. I think one thing that a lot of people don't think about, and that we do see with many business owners, is they aren't charging enough and they don't feel confident to charge that. And they need to work through that. That is an internal heart issue that they got to work on. But there are other things that we need to consider as well, as a part of it, margin improvement. But pricing is one of those things that I think too many people get a lack of confidence in making sure that they're setting the right pricing too. So I hope that answers the question as to what to do if there's a cash flow crunch. But I would say if you're in a cash flow crunch as a result of heavy growth, wonderful problem to have. You need to be talking to a lot of financing providers to help you tap into the assets that you're creating as a result of that growth. That account receivable is an asset, and to figure out how to get financing for it, so that you can deal with that cash flow concern. And you should continue to stay lean. Don't overspend on expenses just because it seems like it's growing great and top line revenue is growing great. Stay lean. If you're facing a cash flow issue because of margin concerns, we've got to figure out quickly how to adjust your contracts. If there's a contract issue, we've got to figure out how to do some strategic buying and sourcing of your materials inputs. We got to make sure your labor utilization is great, but we also got to make sure your pricing is correct and that you're confident that you're pricing appropriately for the value that you do provide.
100%, Mason. So for the audience, where can they find you and reach out to you for your help?
Yeah, easy to find me. I'm pretty active on LinkedIn. We also have I never want to forget this. We have a podcast called Built to Scale. We recently just launched it. We had a previous podcast that we decided to sunset that. And we've launched a podcast called Built to Scale that is specifically aimed at construction business owners. And we nerd out on financial management topics and less about, like proper accounting. Like no business owner really wants to hear about proper accounting. Instead, we give true financial management, tactics that business owners should be thinking about. So some of our recent episodes have been us just literally deep diving elements of this new tax bill that was introduced. And each episode is literally a deep dive on, say, bonus depreciation, economic opportunity zones, et cetera, et cetera. How can contractors and builders be taking advantage of these things? So check us out there. But
that's huge. Where can I find the podcast?
Yeah, you can find it on Spotify, Apple Podcasts, YouTube. It's a video-based podcast, and we try to keep the episodes between 20 and 30 minutes. So it's something digestible that you can listen to on your drive to the work site, whatever the case is. But yeah, you can find some of our content there. I'm really active on LinkedIn. You can find me, Mason Brady, as well as our brand is Brady CFO, and you can find that at bradycfo.com. And we'd love for anybody to reach out. That we just love chatting with business owners, regardless of what size you're at. That you may not be in need of a CFO yet, and that is an important thing. You may not need a CFO yet. It's our personal thought that, especially as you're first starting your business, we really recommend just get really good accountant, get a really, really solid bookkeeper or accounting team that really makes sure that they kick out the financial reports accurate on time. That is a stronger investment that you need to make. That I wouldn't necessarily recommend a CFO for really small contractors, but we still love talking with them to just offer free advice. That we just love helping business owners. So if anybody reaches out, we're happy to hop on a call and do a discovery call and try to consult with you. So don't hesitate to reach out.
Well, thank you so much, Mason. I enjoyed our conversation and definitely going to share his podcast with everybody. So within the next 30 minutes, you'll see the links in the comments. And Mason, do you have an Instagram? Because this will also be linked to Instagram.
I don't. Yeah, okay. My wife does all the Instagramming for our family. So yeah.
All right. So you two people, I will go ahead and put in the comments where you can find Mason's LinkedIn and his podcast. Well, thank you so much, Mason. It was my pleasure to have you on today.
Yeah, thank you so much, Rocio. This was awesome. Thank you for this opportunity, and thank you to all the audience for listening. And it's a Friday, and so I appreciate that we can talk about accounting and finance on a Friday morning, afternoon, whatever that might be. So appreciate y'all.
All right, thank you.
Yep, thanks everybody.